Hello everyone and welcome back to the QuantScore Financial Show, brought to you by Math And Maticians. Today we're diving headfirst into the stock market, specifically focusing on some interesting picks for this holiday week. Just a quick reminder before we get started, I am not a financial advisor nor claim to ever be one, and nothing in this video should be considered financial advice or recommendations. This video is strictly made for financial education and entertainment purposes only. We're just here to learn about the fascinating world of algorithmic stock analysis and quantitative trading. Now, let's talk about the market. Volatility is up, and investors are trying to navigate the uncertainty. But remember, uncertainty can breed opportunity. That's where the QuantScore Financial Show comes in. We use cutting-edge algorithms to analyze thousands of data points, identify trends, in hopes to pinpoint potentially undervalued and overvalued stocks. In this video, we're going to break down 10 companies that have caught our attention for this week. 5 of them are flashing signals of being potentially undervalued, even amidst the current market conditions. The other 5? Well, let's just say our models are raising some red flags. We'll dive into the details of why these stocks might be overvalued and what risks you should be aware of. So, grab your coffee or tea, and let's get right into it. First up, we're taking a look at Unity Software Inc., ticker symbol U. Now, you might know Unity as the platform behind some of your favorite video games. But what you might not know is that Unity is also a major player in the metaverse space. Their software is used to create immersive 3D experiences, and that's a big deal in the metaverse. Our models are showing that Unity might be undervalued right now. Why? Well, for one, the metaverse is still in its early stages of development. That means there's massive growth potential for companies like Unity that are building the infrastructure for this new digital frontier. Plus, Unity's revenue has been growing steadily, and they have a strong track record of innovation. Now, it's important to remember that investing in the metaverse is not for the faint of heart. It's a high-risk, high-reward kind of play. But if you believe in the long-term potential of the metaverse, Unity is definitely a company to keep your eye on. Our models are giving it a thumbs up for potential undervaluation, but remember, always do your own research before making any investment decisions. The metaverse is exciting, but it's important to approach it with a healthy dose of caution. Up next, let's talk travel. Specifically, let's talk Airbnb, ticker symbol ABNB. Now, the travel industry was hit hard by the pandemic, but Airbnb has been making a strong comeback. People are eager to travel again, and Airbnb offers a unique and often more affordable alternative to traditional hotels. Our models are showing that Airbnb might be undervalued right now, and there are a few reasons for that. First, travel demand is surging. People are booking trips left and right, and Airbnb is benefiting from this trend. Second, Airbnb is expanding its offerings. They're adding new features like experiences and long-term stays to attract even more customers. And third, Airbnb has a strong brand and a loyal customer base. People love the flexibility and convenience that Airbnb offers. Now, of course, there are always risks to consider. The pandemic isn't over yet, and new variants could emerge and disrupt travel plans. But overall, our models are optimistic about Airbnb's long-term growth potential. Let's shift gears now and talk about renewable energy. Enphase Energy, ticker symbol ENPH, is a company that designs and manufactures solar microinverters. Basically, these microinverters convert the energy from your solar panels into usable electricity. Now, our models are showing that Enphase Energy might be undervalued, and here's why. The demand for solar energy is exploding. More and more people are looking for ways to reduce their carbon footprint and save money on their energy bills, and solar is a great solution. Although Enphase's PE ratio is far higher than we would normally like, their PE growth ratio makes the investment seem more rational. The stock is also down more than 30% for the quarter, making it an amazing discount moving into our energized future. Enphase is a leader in the microinverter market, and they're well positioned to capitalize on this growing demand. They have a strong track record of innovation, and they're constantly developing new and improved products. Plus, government incentives for solar energy are making it even more affordable for homeowners and businesses to make the switch. Of course, there are always risks to consider with any investment. The solar industry is competitive, and new technologies are always emerging. But overall, our models are bullish on Enphase Energy's long-term growth potential. For our next pick, we're diving into the world of beauty with Estée Lauder Company's ticker symbol EL. This global giant owns a portfolio of iconic beauty brands from Clinique to MAC to La Mer. Our models are showing that Estée Lauder might be undervalued, and here's why. The global beauty market is massive and continues to grow. People are spending more money than ever on skincare, makeup, and fragrances, and Estée Lauder is well positioned to benefit from this trend. They have a strong global presence, a diversified product portfolio, and a loyal customer base. Plus, Estée Lauder is investing heavily in e-commerce and digital marketing to reach a wider audience. Estée Lauder is currently trading at an extremely high PE ratio, but we feel their strong quarterly earnings growth and relatively flat trading month feel it makes Estée Lauder an amazing opportunity. Now, it's important to note that the beauty industry is competitive and trends can change quickly. But Estée Lauder has a long history of success, and our models suggest that they're well equipped to navigate the challenges ahead. Let's talk about a company that's been a staple in kitchens for generations. General Mills Inc., ticker symbol GIS. They're the name behind some of your favorite cereal brands like Cheerios and Lucky Charms, as well as other popular food items like yogurt and snacks. Our models are showing that General Mills might be undervalued regardless of what's happening in the economy. General Mills provides essential food items that are always in demand, making them a relatively stable investment, even during times of uncertainty. Plus, General Mills has been adapting to changing consumer preferences by introducing healthier options and expanding into new categories, like plant-based foods. Of course, the food industry is competitive, and General Mills faces challenges like rising input costs and changing consumer tastes. But overall, our models suggest that General Mills is a solid company with a strong track record and potential for growth, working with strong, consistent financials and an attractive dividend. Now we're switching gears and looking at some companies that our models have flagged as potentially overvalued. First up, we have Robinhood Markets. Ticker symbol HOOD. Robinhood burst onto the scene a few years ago, promising to democratize investing and make it accessible to everyone. While they've certainly attracted a lot of users, our models are raising some red flags. One concern is Robinhood's reliance on payment for order flow, a controversial practice where they route their users' trades through high-frequency trading firms. This practice has drawn scrutiny from regulators and raises questions about whether Robinhood is truly acting in the best interests of its users. Additionally, Robinhood's user growth has slowed, and they've faced criticism over their customer service and platform outages. While Robinhood has the potential to disrupt the brokerage industry, our models suggest that their current valuation might be outpacing their fundamentals. With that said, Robinhood has had extremely strong quarterly revenue and earnings growth, making it a very difficult company to bet against right now. Next up, we're looking at TPG Inc., a global alternative asset management firm with a similar ticker symbol, TPG. TPG is a major player in the world of private equity, with investments in a wide range of industries. However, our models are signaling that TPG might be overvalued at its current price. One concern is the increasing competition in the private equity space. There's a lot of money chasing deals right now, which can drive up prices and make it harder to find attractive investment opportunities. Additionally, private equity returns have been declining in recent years, and there's no guarantee that TPG will be able to maintain its historical performance. While TPG has a strong track record and a talented team, our models suggest that investors should approach this stock with caution, growing nearly 60% over the past quarter, due for a slowdown and rebalancing. Let's talk about Caterpillar Inc., ticker symbol CAT, a global manufacturer of construction and mining equipment. Caterpillar is a cyclical company, meaning its fortunes are closely tied to the health of the global economy. Our models are indicating that Caterpillar might be overvalued right now, and there are a few reasons for that. First, global economic growth is slowing. The International Monetary Fund has cut its growth forecast for this year and next, citing factors like the war in Ukraine, rising inflation, and supply chain disruptions. This slowdown could hurt demand for Caterpillar's products. Second, Caterpillar is facing rising input costs. The prices of steel, copper, and other raw materials have been surging, which is squeezing Caterpillar's profit margins. While Caterpillar is a well-managed company with a strong brand, our models suggest that its current valuation might be too optimistic given the challenging macroeconomic environment. Now let's talk about the TJX companies, the parent company of popular off-price retailers like TJ Maxx, Marshalls, and HomeGoods. TJX has built a successful business model by offering brand-name merchandise at discounted prices. However, our models are indicating that TJX might have grown a bit too much, and in need of a good discounting, like many of the items before reaching their stores. One concern is the increasing competition in the discount retail space. Target, Walmart, and even Amazon are all expanding their off-price offerings, which could put pressure on TJX's margins. Additionally, they are facing rising costs, including higher wages and transportation expenses. Although TJX currently has a reasonable PE ratio, their forward-looking PE ratio provides a grim outlook for the future of the company. While TJX has a loyal customer base and a proven ability to navigate challenging retail environments, our models suggest that investors should be cautious about paying a premium for this stock. Finally, let's look at Argenx, ticker symbol ARGX, a biotechnology company focused on developing treatments for severe autoimmune diseases. Argenx has a promising drug in its pipeline, efgartigimod, which has shown positive results in clinical trials for treating generalized myasthenia gravis, a rare autoimmune disease. However, our models are signaling that Argenx might be overvalued at its current price. One concern is that Argenx is still a clinical stage biotech company, meaning it doesn't have enough products on the market yet. Developing and commercializing new drugs is a risky and expensive process, and there's no guarantee that efgartigimod will be successful. Additionally, Argenx is facing competition from other biotech companies that are also developing treatments for autoimmune diseases. While Argenx has the potential to become a major player in the biotech industry, our models suggest that its current valuation is based more on hope than on tangible results. Alright everyone, there you have it. Our breakdown of 10 stocks that our algorithms have identified as potentially undervalued or overvalued for this week. Remember, this is just a starting point for your own research. Don't blindly follow any model or algorithm, including ours. Always do your own due diligence. Consider your own investment goals and risk tolerance, and consult with a financial advisor if needed. The market is constantly changing, and what looks good today might not look so good tomorrow. That's why it's important to stay informed, stay disciplined, and never invest more than you can afford to lose. As always, thanks for watching, and be sure to like, comment, and subscribe to Math and Maticians for more from the QuantScore Financial Show. Until next time, stay calculating, my friends.